Welcome to the Deep Dive, the show where we cut through the noise and get straight to the insights you need to be truly well-informed. Today, we're diving deep into a quarter that, well, it sent ripples across the financial world. Meta's Q2 2025 earnings, their shares surged, 11% after hours? Pretty remarkable. So our mission today, it's custom tailored for you. We're going beyond just those initial headlines to really understand the why behind Meta's impressive number and strategic moves. We'll use a structured kind of five-part framework to analyze their official press release and the market data. Think of this as your shortcut to a comprehensive, clear understanding of Meta's performance and, future direction. Let's jump in.
Absolutely. And what's really fascinating here isn't just that Meta delivered good numbers. It's that those numbers decisively surpassed what the market expected. That's what really sparks this kind of enthusiasm.
That's right. The market certainly reacted as if it was a resounding beat. And to truly understand that strength, let's begin by looking at the core performance against those market expectations. Now for slide 1, the at-a-glance scorecard. So how did Meta stack up? They delivered what analysts are indeed calling a resounding beat on both revenue and earnings per share. Their total revenue came in at an incredible $47.52 billion. Now, to put that into perspective, the consensus analyst estimate was, around $44.81 billion?
Yeah, about that.
Meaning Meta surprised everyone by over $2.7 billion. That's a positive surprise of about 6%.
Which is substantial at this scale.
Definitely. But the profit story, well, that was even more pronounced. Diluted earnings per share hitting $7.14. That's a whopping 21% higher than the $5.88 forecast.
21%. That's huge.
Yeah. And that 11% surge in shares on July 30th, 2025. $12 in after-hours trading. That really tells you the story of how quickly the market processed this. Initial analyst sentiment was, overwhelmingly positive, highlighting strong execution, the power of their AI-driven advertising, and a very robust outlook for the future.
Makes sense, given the numbers.
And when you zoom out to look at the year-over-year growth, the picture gets even clearer. Total revenue grew a robust 21.6%. That's from roughly $39.1 billion in Q2 2024 to $47.5 billion this quarter.
Solid growth there.
Net income jumped over 36%, reaching $18.3 billion. And diluted EPS, that saw a remarkable 38.4% increase, climbing from $5.16 into $7.14.
Okay, and this is the key story this quarter, I think. This is where it gets really interesting. It's that significant gap between the 21.6% revenue growth and the much faster acceleration in profitability. Net income up 36.2% and diluted EPS up 38.4%. This surge in profit isn't accidental. It's driven by two powerful financial dynamics.
Right. What are those?
Well, the primary driver is operating leverage. In simple terms, this just means the company's revenue is growing faster than its costs. It's basic, but powerful. For Meta in Q2, while revenue grew by that strong 21.6%, their total costs and expenses increased at a much slower pace, only about 11.8%.
Wow, only 11.8% cost growth.
Exactly. So this efficiency means that a larger portion of every new dollar of revenue fell directly to the bottom line. That caused income from operations to surge by almost 38%. It clearly demonstrates a highly scalable business model.
Okay, so that explains the jump in operating income. What was the second factor?
The second factor, which further amplified the EPS growth specifically, is strategic share repurchases.
Yes.
Diluted EPS is, a crucial metric for investors because it shows profit on a per-share basis. By reducing the number of shares outstanding through buybacks, the same amount of net income gets divided among fewer shares, so it boosts the earnings per share number.
Mechanically boosting it.
Right. Meta spent nearly $9.8 billion on these share repurchases, reducing their shares outstanding. And this mechanically pushed that diluted EPS growth from the 36.2% net income growth up to that impressive 38.4%.
It's a smart way to return value, and it signals confidence too, right?
Absolutely. Signals management confidence in future cash flows.
So we've seen Meta's top-line numbers and how they're accelerating profit growth. But what truly struck me was how much more profitable Meta seems to be getting, beyond just that top-line growth. Can you help us understand the engine behind that increased profitability? Moving to slide 2, the engine of profitability.
Absolutely. Yeah, the story of profitability really shines through in their margins. Meta's operating margin, that's how much profit they make from each dollar of revenue after operating costs. It expanded impressively to 43%.
43% from 38% last year.
From 38% in the prior year, yeah, that's a 5 percentage point improvement, which is significant in Meta's scale. Huge improvement.
Okay, how did they achieve that?
Well, this margin expansion isn't just luck. It's a direct result of disciplined cost management. If we look at how different expense lines grew compared to their 21.6% revenue growth, you see a clear strategic intent. Cost of revenue, that grew slower at 16.2%. Marketing and sales grew just 9.5%, showing significant leverage there.
Okay.
And remarkably, general and administrative expenses actually decreased by over 27%.
Decreased. Wow.
Yeah, decreased. A clear sign their earlier cost-cutting, the year of efficiency stuff, is really paying off.
Right.
Research and development was the only area where spending deliberately accelerated, up almost 23%.
Oh,
That signals their aggressive AI investments.
makes sense.
And even their gross margin, which is what's left after just the direct cost of revenue, improved slightly to over 82%.
Okay, that's a very clear picture of efficiency driving margins up. But while their accounting profit soared, I noticed their free cash flow, or FCF, actually told a bit of a different story. Can you explain that divergence for our listener?
Yeah, this raises a really important point. FCF, the cash a company generates after covering operating expenses and capital expenditures. It's often seen as a more, let's say, direct measure of financial health, less influenced by accounting rules.
Right. The actual cash coming in and out.
Exactly. And in Q2, Meta's FCF actually decreased to $8.55 billion from $10.90 billion last year, even as net income grew over 36%.
Okay, so profit up, cash flow down. Why?
The why behind this decline is basically a single, deliberate strategic choice, a massive increase in investment. While their cash flow from operations remained exceptionally strong, actually grew 32% to $25.56 billion.
That's great.
Their capital expenditures, the money spent on things like data centers, servers, property, equipment, more than doubled year over year.
Doubled.
Yeah, from about $8.2 billion to a staggering $16.5 billion in just one quarter. This enormous investment in infrastructure, predominantly for their AI initiatives, is the sole reason for the reduction in FCF.
So they're intentionally spending cash now for future growth.
Precisely. It highlights Meta's central strategy, using the immense profitability of its current business to fund a truly historic investment cycle in its future. It's a deliberate trade-off. Cash now for potential dominance later.
That's a fascinating trade-off, and it makes me wonder about the different parts of Meta's business. To truly understand these results, I guess we need to break down the performance of its distinct segments. Now, for slide 3, the engine room business segment performance.
Exactly. To truly understand Meta's overall results, you really need to recognize that they operate two vastly different businesses under one roof. You can think of them almost as two separate companies. You've got the hyper-profitable family of apps, and then the deeply investment-focused Reality Labs.
Right, the established giant and the future bet.
Pretty much. The family of apps, or FOA segment, that's Facebook, Instagram, WhatsApp, Messenger, remains the undisputed financial juggernaut. This segment's revenue grew by a robust 21.8% year over year, hitting over $47.1 billion.
Just that segment alone.
It's just FOA. And even more impressively, its operating income surged by 29.1% to nearly $25 billion for the quarter.
$25 billion in operating income from the apps.
Yes. This performance truly underscores the immense power and profitability of Meta's core advertising business. It continues to benefit hugely from AI-driven improvements in ad targeting, user engagement, just a very, very well-oiled machine generating significant cash.
Okay, so that's the engine. What about the other side?
Right. On the flip side, we have Reality Labs, or RL. This focuses on virtual and augmented reality hardware, software, the metaverse stuff. This segment continues its long-term investment phase. Revenue for RL was essentially flat at $353 million, tiny compared to FOA. But its operating loss actually widened slightly to $4.53 billion for the quarter.
$4.5 billion loss.
In one quarter.
In one quarter.
Okay, here's where that stark contrast becomes incredibly clear, right? And you see the strategic implication of what they're doing. The family of apps segment generated enough profit at nearly $25 billion to completely absorb the $4.53 billion loss from Reality Labs. Completely cover it.
And still deliver over $20 billion in total operating income for the company overall. That's a huge insight right there.
It really puts it in perspective.
Yeah. If you stripped out the drag from Reality Labs, Meta's corporate operating margin would have been, what, a staggering 52.5%?
Exactly. An absolutely massive margin.
So the market's positive reaction clearly indicates that investors, right now anyway, view this substantial quarterly loss from Reality Labs as a kind of necessary investment, like a tax on current profits for the potential of owning the next big computing platform.
That seems to be the prevailing view, yes. They are funding the future right now directly from today's profits. The market seems okay with that bet, especially given the AI upside in the core business.
Speaking of funding these massive investments, it does raise an important question. How strong is Meta's financial position overall? Can they actually sustain this? Moving to slide 4, financial strength and shareholder rewards.
That's an excellent question. And the answer is yes, they absolutely can. Despite these massive investments, Meta maintains what you'd call a fortress balance sheet. It's incredibly strong. As of June 30, 2025, the company held a massive liquidity cushion, over $47 billion in cash, cash equivalents, and marketable securities.
47 billion just sitting there.
Just readily available cash.
Yeah.
This means they have a huge amount to deploy for investments, buybacks, whatever they need. And their balance sheet structure is also very conservative. The company's debt-to-equity ratio, a key metric for financial leverage, was just 0.51.
0.51, that's low, right.
Very low. It's based on about $99.7 billion in total liabilities against $195.1 billion in total stockholders' equity. A ratio below 1.0 is generally considered very healthy, and Meta's position indicates its assets are funded nearly twice over by equity compared to debt. Very little leverage risk.
Well, that financial strength is like a strategic weapon.
Exactly. This fortress balance sheet is truly a strategic weapon. It provides the stability required to fund their ambitious, multi-billion-dollar investments in AI and reality labs without taking on excessive risk. Think of it like Meta having this massive, sort of impenetrable war chest. It allows them to pursue a dual mandate, investing aggressively for the future while simultaneously rewarding current shareholders.
Right. And on that note, let's talk about their commitment to returning capital to shareholders, because they did a lot of that too. Meta continued to execute a robust capital return program during the quarter. They repurchased nearly $9.8 billion in their Class A common stock.
Almost $10 billion in buyback.
And paid out an additional $1.33 billion in dividends. So that means in Q2 alone, Meta returned over $11 billion directly to its investors.
11 billion back to shareholders in 3 months.
Yeah. And this robust capital return program isn't just a number, is it? It signals management's confidence in the company's future cash flows and its commitment to delivering shareholder value, even while undertaking this historic investment cycle.
It absolutely does. It says we can invest heavily and still return huge amounts of cash. That's a powerful message.
That confidence certainly seemed to resonate with the market. So let's talk about what Meta's management is actually saying about the road ahead. What's their outlook? Now for slide 5, the road ahead management's outlook and key takeaways. Okay, one of the biggest drivers of that positive market reaction, maybe even more than the Q2 numbers themselves, was Meta's outlook for the upcoming quarter. Management's guidance was extremely bullish. The company projects third quarter 2025 revenue to be in the range of $47.5 billion to $50.5 billion.
Big range, but the midpoint.
Right. The midpoint of that range, $49 billion, was significantly higher than the pre-earnings analyst consensus, which was around $46.3 billion. That signals really strong continuing business momentum.
A big beat on guidance too then.
Exactly. On the spending side, Meta narrowed its outlook for full year 2025 total expenses, now between $114 billion and $118 billion. They also tightened their capital expenditure guidance for 2025 to a range of $66 billion to $72 billion. Interestingly, they actually raised the lower end of the previous range.
So, still planning massive investment.
Definitely. Management emphasized that infrastructure costs, specifically driven by the AI build-out, would be the largest driver of expense growth again in 2026, reinforcing their long-term commitment there.
All in on AI infra.
Pretty much. They also mention they're keeping a close eye on regulatory headwinds in the EU, which could potentially impact their European revenue down the line. Something to watch.
Always a factor in Europe.
So what does this all mean for you, the listener, and for Meta's trajectory? Let's try and distill the key takeaways from everything we've discussed. First, I think it's clear this was a decisive earnings beat fueled by an AI-powered ad engine. Meta comprehensively surpassed market expectations. They showed incredible efficiency and the just undeniable power of its core business, which is being significantly enhanced by artificial intelligence.
Agreed. The core business is firing on all cylinders, amplified by AI.
Second, we're seeing an all-in on AI. The invest and reward strategy. The company is executing this dual strategy, record investment. You saw that nearly $17 billion quarterly capex alongside robust shareholder returns over $11 billion.
And this balancing act is really only possible because of that fortress balance sheet we talked about.
Mhm.
And clearly, the market is endorsing it right now as a sound long-term strategy.
Yeah, it's not just Meta doing this either, is it? We're seeing this across big tech, using current cash cows to fund these huge AI bets. It's kind of redefining what a mature tech company looks like.
Absolutely. It's the new playbook.
Third takeaway. It clearly highlights the two metas, a clear view of the subsidy. This quarter starkly illustrated how the hyper-profitable family of apps segment, with its $25 billion operating income, is directly funding the deep ongoing investment in Reality Labs, which lost that $4.5 billion.
Yeah, that internal subsidy is essentially the price of admission, the cost for a shot at owning the next potential platform in VRR.
And finally, there's just confidence radiating through guidance. Management's bullish Q3 revenue forecast, crushing consensus, combined with that aggressive capital return program. It projects a powerful message of confidence in the business's trajectory. It really justifies that strong post-earnings stock rally.
Totally agree. The guidance was key. So to summarize, you can really say the second quarter of 2025 was maybe a landmark period where Meta truly proved it could master its present to aggressively build its future. You know, that year of efficiency clearly forged a leaner, more powerful profit engine in the core ad business. And that engine is now being used to fund one of the most ambitious capital investment cycles in corporate history, aimed squarely at AI leadership.
Right.
While the metaverse, yeah, it remains a costly and distant dream, investors have decisively shifted their focus to the tangible results and the immense potential of the AI strategy right now. The quarter's story is really one of spectacular execution, where disciplined management of current operations is enabling this audacious, expensive, and, at least in the market's view today, extremely promising bet on the future of technology.
That makes sense.
And this kind of structured analysis, really helps you move beyond just the headlines and build a deeper understanding of your investments, don't you think?
Absolutely.
It shifts your perspective from just what happened to why it happened and maybe what it might mean next. Okay, just the usual reminders. This deep dive is for informational purposes only. It does not constitute financial, investment, legal, or tax advice. All investment decisions should be made based on your own research and in consultation with a qualified financial professional. While efforts have been made to ensure accuracy, no guarantee is provided.
And also, this report was generated by an artificial intelligence model. It integrates data directly from the company's official earnings press release with publicly available market data. Although the AI is designed to adhere to strict data sourcing and verification protocols, errors or omissions may still occur. All information, including financial data and calculations, should be independently verified by the user before making any decisions. Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.